I've been hearing the same thing everywhere lately. Multifamily is dead. No rent growth, rates are higher, deals are just not penciling, capital is frozen, it's stuck, nobody's investing. I understand why people feel that way, but I think that take is a little bit misleading and a little shallow. Guys, multifamily is not dead. We're just in a market correction, and corrections don't feel good, especially if you're operating deals, but this is the way the world works. There are cycles. So when people say multifamily is dead, what they're really saying is that the game has changed and maybe they're not equipped to handle it. So rents have stopped climbing. Of course, it was insane in 2020, 21, 22. You can't sustain 13 to 20% rent growth year over year. It's just not possible. People can't afford it. And what has happened since then? Cap rates have expanded. Debt got more expensive, although historically it is at where it's supposed to be, the historical average. But it got more expensive from where it was in 2020 to 2022. And a lot of deals depended on refinances or aggressive growth to get those deals converted into long term debt. So, what happened? People got into trouble. And what actually died was not multifamily, but easy money. And here's the part that a lot of operators don't always say out loud. Capital has options again. Right now, investors can sit in high yield savings accounts or money market funds and earn returns without a risk. It's 4 or 5%, which is epic. It is more liquid than a traditional multifamily syndication. There are no capital calls and there's no operator stress. So it makes sense for the capital to shift where the returns are. High yield interest rate savings accounts, money market funds. It is safer and more secure. So when somebody says, well, why should I be investing in real estate right now? It is definitely the question you should be asking. And if the answer that you're going to tell them is, well, you got to be optimistic about the market, then you're not really ready to be a good operator today and raise capital in this type of market environment. I'm going to say this flat out. Raising capital today sucks. I'm not pretending. I'm not making things up. It is not easy. People do not want to invest in multifamily right now, and it makes sense. Either they're struggling financially themselves, or, like I said before, their money shifted to a safer bet. So investor capital follows returns. And today, safe money pays. That doesn't mean that investors are wrong. It just means that the bar is now higher for us, multifamily investors, for us, the owner operators of multifamily apartment buildings. But again, you have to get creative. You have to know your stuff, and you can't just run away from investing. There are market cycles. It is real, and it has been so historically since the beginning of time. And today's market is scary for a lot of new operators like myself because there's nowhere to hide. You have to put in the work. Like I said, rents are flat and even down in many markets, including on my portfolio. We are not able to raise rents significantly unless it's a lease renewal. Okay. And a lease renewal is different than a new lease because people are willing to pay a little bit more just to stay put. Okay. Insurance and taxes have gone up significantly from 2020. However, we have had a recorrection to now where insurance rates are finally back down 15, 20% to where they were a few years ago. Just to give you a quick example, we closed our first apartment building and we were paying $750 a unit a year for insurance. That same building a few months later went up from $750 to $1350 a unit a year. That is nearly doubled to where we had it when we first got it under contract and closed on the deal. Today, we're back down to under $1,000 a unit a year for insurance. Thank goodness. So there are ebbs and flows with insurance and other expenses, but overall, expenses are up significantly based just solely on inflation. Everything costs more these days, so things are up. And the insurance jumped up significantly, mainly because of the different storms that happened down in Florida. And since we had a couple of quiet seasons, those rates are now coming back down, thankfully. And on top of that, the residents, our tenant base, the people that pay our mortgage and our bills, their income is stretched as well. So income is down across the board as well, and people are struggling. Unemployment is up. There are real issues in today's economy. So if your deal needed rent growth just to survive, this market exposed that. And that doesn't mean that multifamily is dead. It just means that your lazy, weak, overprojected underwriting is wrong. So you have to go back to the drawing board today if you're looking to close on a multifamily apartment complex, and you need to understand your underwriting better than you did back in 2020. Don't project huge returns, don't project huge rent growth, and don't dismiss the expenses going up, because expenses are certainly rising today. And as painful as all of this feels, this correction is actually healthy for us. It forces discipline back into the business and exposes the real operators to actually operate and build systems that will work in a down cycle. Deals have to work in today's math. You can't project these crazy increases in rents just to push the values of a property. It just doesn't happen. You have to maintain rents being flat when you're underwriting. And will the deal still pencil under that math? This typically means you're going to be offering a lower purchase price. And if you're able to get a property to cash flow, especially by purchasing at a lower purchase price, and then you get it to cash flow under today's environment with today's interest rates and today's expenses, keeping rents flat, 3 to 5 years from now is where the gold will happen. That's where things will start to change once the market shifts back to a seller's market. And reserves are still important, guys, because you're going to hit walls, you're going to hit challenges, you're going to hit situations where you might need to pull on those reserves because expenses have gone up or turnover has gone up or the residents couldn't afford the rents and there are unexpected lease breaks. So you really need to have your reserves in check, and you really need to understand that your operations are going to keep you afloat. This means instead of you putting 1 to 2 hours a week in for your operations and staying dialed in, you might have to put 3 to 5 hours a week in for your operations per property. Instead of just advertising on Zillow and apartments.com, you might need to go to advertising your units on Facebook Marketplace, back to Craigslist again. You have to find the renters, you have to find people, you have to be a notch above the other operators who are just sitting there thinking that it's the same time from 2020 to 2022 when life was easy as an operator, because today it's not. So, me personally, am I pulling back? No, but I'm not being reckless either. I'm underwriting for flat rents. I'm stress testing the debt today. I am over reserving because reserves are what keep a deal afloat. And I'm walking away from deals more than ever. So I'm not closing 5 deals a year. If I can get one this year, that would be amazing. But again, sellers are still somewhat unrealistic in the sense that they're not willing to drop their price. Some of them can't because they have a certain return metric that they need to hit, or they don't want to be underwater when they sell. Others need to sell just because their debt is coming due or they're struggling significantly with operations to where they're losing money. So going all in today, which is what I always am, doesn't mean going in blindly. And here's the truth that nobody likes hearing. If you want safety, liquidity, and certainty, that's okay. But don't confuse that with building long-term wealth, because real estate was never meant to be comfortable in the short term. You have to hold for the long term. The longer you hold, the more your tenant base or renters are paying your expenses and paying off your debt. Remember, if you have $1 million loan, those renters are paying that down for you. Okay. So if the market does correct and come back up, even to the level of 2022, you could be sitting on 30-40% equity when that happens. And today's market is not punishing investors. It's really just exposing operators that are not really here to operate. And again, as I've said it before, I have seen so many people back out of this game just because they're not doing well in today's market environment. And the people that survive this environment are the ones that are going to be the next generation of epic operators. So you need to decide, do you want to be an amazing operator, or do you want to back out and chase the small returns that might be in money market funds or high yield savings accounts? Or do you trust that real estate eventually is the slow rolling train that always survives? So let's close this out, guys. Multifamily is not dead. It's just not forgiving anymore. It is not easy. And if that scares you, good. That's normal. Not everybody should be involved in this game. But if that excites you, you're probably built for multifamily real estate. And stick around, guys. This cycle is going to separate people, and it's going to change, whether it be 3 or 5 years from now. And you don't want to be the person kicking yourself saying, I wish I had invested 3 or 5 years ago, because that is always the case. And if you are considering investing or learning how to underwrite, you should go to my Stan store, stan.store/buy buildings. There I have a number of free products, also paid products that you can buy to learn how to underwrite deals, analyze deals. And I have a full course already there. It's evergreen. It is already recorded and uploaded for you to start today, learning how you can be the best multifamily investor that you can be, owner, operator, syndicator, whatever you want to be. It is there for you. And if you need some hand holding, I also offer my multifamily machine where you get the course, you get my deal analyzer, and you get me for one-on-one calls and group coaching for a total of 8 weeks. And the multifamily machine is designed to get you from point A to point B, whether that be from buying your first multifamily property, your fifth, or your 10th. I help people get to the next level. So again, go to my Stan store, stan.store/buy buildings, and learn how you can buy buildings today. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.